Let's talk about cycles in the business and economy. So this series I will dedicate to calling it GDP cycles, economic cycles. We will focus on different sectors in the economy to derive what cycles are currently relevant in different areas of the business cycle. So in today's episode, I will especially focus on the materials, the primary sector of the economy, to see and uncover what the business cycle in this sector are. So stay with me for the next 20 minutes and we will have a joint analysis.
From the mind of Lars von Tienen, the most advanced cycle analysis, hot off the press.
Yeah, you're watching Cycles TV. By the way, thanks for joining. We have Monday, same time, same place for another episode of Cycles TV. Yeah, let's jump in. As I mentioned already, the focus for this session is especially, let's more focus on business cycle dynamics related to different components of the GDP. So instead of just looking to an index like the S&P 500 or the NASDAQ, just one asset or one index, let's try to nail down where the cycles are in those specific sectors. As a primer, before we jump into today's episode, we need to understand that the economic cycle dynamics are differentiated into these four economic sectors, like the primary sector, where materials are extracted for further production, and that further production takes place in the secondary sector, where all the production, manufacturing, construction takes place, which will then produce goods which are used by the tertiary third sector, where those products get used and additional companies will provide services around those produced goods. And then we have the fourth sector, which then contains of additional research, education, and technology provided around all these sectors. So those four sectors make up the economy. They are all part of the S&P 500. But, and that's the key statement, the cyclic behavior within those sectors might be different. So therefore, instead of just looking at one index like the broader market, which contains an aggregate of all those sectors, which might it be complicated, if not impossible, to derive the most dominant cycle, it makes more sense these days to analyze the cycles in those individual sectors. And maybe there are points in time when those dominant cycles in those sectors align their trough or their peaks. Then you will see a major peak or bottom in the broader indices. And sometimes these cycles might be out of sync, so that one sector is turning up, the other sector is turning down, and you might see just a volatile move in the overall indices. So as said, it might be much more useful to have an understanding about the cycles in those sectors before judging an overall broader index cycle, right? So, to get this started, I think 2 months ago, I made an analysis on the secondary sector already. So to bring you to speed, if you have not seen that, I would recommend you take some time, maybe also at least if you have in this area here. So you can see it's called Recession or What? Market Cycles Report, September 29th. It's not in the title, but in this episode I reviewed the construction and manufacturing area, so which is the secondary sector. So if you want to recap how the cycles look like in the secondary sector, jump back to the end of September, beginning of October episode on manufacturing and production. And today we will move back into the sector. So today we will move into the primary sector, the raw materials sector. So, so let's maybe start with the previous analysis. If you have in mind the manufacturing and production cycle I showed in the end of September episode was already in negative territory. So that cycle moved into a negative downward phase in the secondary sector, which is close to or very early when those recessions are labeled after the fact. So manufacturing and production already is in a deep dive. As mentioned, please review that video to get more details on that. So second, before now jumping to the materials sector, you can also watch indicators like the leading indices data provided by the conference board, which aggregates also different economic measures. Their latest finding on those economic measures, and that's what I just bring to your attention here, is that this indicator also provided or triggered a recession signal in August. I just want to bring this in because that confirms the analysis we did here at beginning of October, end of September, where we analyzed production and manufacturing. That sector is also in a negative, it's contracting. It's not in expansion, it's in contraction, which is kind of confirmation on the leading indicators also here. So we have two different analyses. If you take out the third sector, like service products, like which are provided by AI, or the hope in those service products overshadows all other sectors right now. Therefore, it's even more important that in the other sectors, it's not as bright as technology and AI services might suggest. So we need to be careful here. All right, so now let's go right to the meat of today's session. The materials sector is measured with the S&P 500 as a special sector component. So we all can pull up the data for the S&P 500 materials. It's measuring all companies related to the primary sector, which I just explained. I think it's between 15 and 35 companies which make up that primary materials extraction sector and can be measured as a sector. And let's start with the longer term perspective, as always, to see where we are, because that's also already an interesting point if we want to judge business economy cycles and US stock market indices. So let's start with the long-term series, as mentioned here. So here we have the S&P 500 materials as a weekly chart. You can pull that up directly within our platform. It is provided via different ways, and here we see the current valuation. So first off, it's interesting that this index peaked at the end of 2024 and never made it back here during 2025. So it's still in a kind of declining situation, just looking at the raw data. That said, first, let's now have a look at the spectrum to extract, or at least to check where the dominant cycles are. And for the long-term followers of that channel, it would not be a surprise. But look at that spectrum. I mean, there is one clear dominant cycle which just stands out of all other cycles, and we don't even need any additional measures or statistical verification. This cycle here, with a length of 182 weeks, is quite known. So this is not by surprise, that long-term cycle is almost visible in all long-term economic business-related cycle series. It is the around 42 months cycle we are very well aware of from Dewey's work. So that cycle goes back into the 1920s, 1930s, when this cycle was first discovered, and it's still valid up to today. So that's not a one-time pop in the spectrum. That 182 weeks, roughly 40-month cycle is in the business, in the economy since 1920, 1930. It is observed and monitored. And we still, this is just latest data. Yeah? This is not going back to 1920. This is just going back for the previous 15 years. So that's really the current data set. And there's no discussion that there is this cycle, which is the most active here. I mean, even our statistics speak for themselves. So ranking number 1, stability, close to 0.87, which is a very, very high stability ranking. It's outstanding here. So let's activate that cycle. As said, almost no discussion. We can see it as an overlay in the previous historical performance, but let's zoom in a little bit more to the current status quo. And here, and that's what I wanted to mention first, it's clearly in alignment with that topping indication, which was anyhow projected here on that channel for end of 2024. So that long-term 40 months, 182-week cycle, we observed and reported on that cycle very often on that channel here, which has been expected to peak end of 2024. So it's also no surprise how it's looking here. And to be honest, just looking at the primary sector in the economy, that cycle is still right on track. As I would say, it's running on rails since that point in time. Yeah, so we turned down, we had a small recovery, now turned down and made a lower high. So that's quite intact. So the long-term cyclic perspective on the economy in the primary sector should be clear. Long-term, no surprise at all. But you would see a different picture if you just look at the S&P 500, as it is skewed by the third sector, where all the high capitalized IT service companies have a high hope on AI services in the future. In the business and the economy, besides these AI capex spend, it's not visible. Today's economy, where materials are extracted, which are required for further production and manufacturing, is not growing. It's shrinking, and the long-term business cycle is pointing down even into 2026. And it's on track. So as said, that cycle, we reported that here to expect the top end of 2024. So that's the long-term perspective, which is nicely visible on the primary sector or the materials. Also, not to get blinded all the time by the technology and the AI bubble which is out there. The economy and the business also consists of much more than just the hope in AI. So therefore, we need to refresh our mind that there are different cycles going on in different sectors of the real economy on Main Street, not Wall Street. So, okay, we have the long-term cycle on materials. We have the long-term perspective. Now let's switch to the daily perspective. Therefore, we open the same chart as a daily chart. So I'm switching now from weekly to daily. Therefore, the spectrum here at the bottom also has changed, because now we will observe the behavior related to daily cycles. That's why the spectrum looks different. So let's have a closer look. And I mean, from the visual shape here in the spectrum, we can see we have a huge bump, which is nicely shaped at 314 days. We have another one which is here, a third one which is placed here, and then maybe a shorter one here at 79 days. So if you're familiar with how to read the cycle screen, you know that we mainly take a look at the stability score besides the visual shape in the spectrum. The stability score gives us more confidence on the variability of that cycle. So, and the reason for doing that is that we want to identify those cycles which have been stable over time. And stable means they have not altered their length. So the length of that cycle was quite stable. They have not altered so much their phasing. So have not jumped around from moving from highs to lows. And their amplitude. So the impact on the market has also been stable over time. Because otherwise, it would not make sense to pick such a cycle for projection or for forecasting. Because if you use cycles for forecasting, which are volatile, which have a high variability in their cyclic parameters, I mean, it's good in hindsight to detect those cycles, that they have been there at some state in the past. But if you are not able to predict phase, length, and amplitude into the future because it just had shifted in the past too much, it makes no sense at all to use that cycles for projection. So that's always an important story, and I repeat that here on the channel quite regularly because that's the key. That's the key of cycle analysis. Don't forget that. Identifying cycles with a spectrum analysis is easy peasy. Everyone can do that. You can run your analysis algorithm from everywhere. You don't need that application here. You have a spectrum that's on the fly, in real time. That's every ship has that embedded. Generating a spectrum, analyzing cycles is nothing special. The key is, and that's why I'm repeating that topic, the key is your knowledge and the capability to decide which cycles which have been there in the past should be used for future projections. That knowledge, that makes the difference. That's the edge a cycle analyst has using tools. Software and tools these days don't have the capability to put this into a meaningful, simplistic solution. So that's why tools can help us, but there's still some knowledge and capability available from you as an analyst to make that decision. In order to help you, we have created those measurements like stability. Long story short, only 4 cycles from that spectrum here qualify for further projection because they have high stability scores. So I will stop that story here, but it's always important to remind ourselves on that. So let's start with the longest cycle here, which gives us a nice phasing. I mean, even 0.86 as stability score on a daily cycle is quite impressive. So that's why that cycle over time has more or less a perfect alignment of what happens in the past. So it also explains that we had cycles within cycles alignment here around end of the year. So the daily cycle topped, while also the longer term weekly cycle topped, which then triggered that downswing here into April. From April, the shorter term cycle has now switched into a positive cycle within the longer term downswing move, which has turned now in September, October. So maybe you remember that we often talked on this channel here on a possible short-term cycle top late summer this year, which can be clearly seen here in that series. So that's the main cycle, which is even pointing down into first quarter 2026. And now we can continue to even add up the shorter term cycles. That's why I start always with the longest cycle first, which has the main information here. So Those have similar strength, not perfect strengths, but they still qualify above 0.5. So let's use the one with the highest strength next. So strength gives us an indication about what is the most impact on price movements from that cycle. Yeah, so it's the 79-day cycle, which is quite a short cycle. But if we activate that as an overlay, yeah, it shows us a little bit here the bumps on the road, which are also visible in the price series, which, I mean, could play for another short up move into year end, but then the story goes on. And then let's add up also the other two shorter term cycles. And then there's nothing more to add. And I often tell you, don't add more than 3 or 4 cycles into a composite. Otherwise, it will get close to a curve fitting to the past and, again, has no value in forecasting. So here we have the most important 4 cycles, which qualify also to build a projection based on their shape and their reasoning in the spectrum. And this is how the short-term projection for the primary sector materials look like. And now we have 2 points which require our attention. Maybe you already spot them. Let's zoom in a little bit. First, I mean, that's obvious. It looks like we have a short-term upswing cycle around the corner, or that correction here might come to an end or a pause here. So that's the first topic we see from that short-term cycles here. Second, and we need to be careful here in the interpretation, we are well aware, or we should remind ourselves, that the long-term cycle is pointing down. So therefore be careful with short-term upcycle projections in a longer-term down cycle swing. And then the next turning point comes into play, which is quite important to have that in mind, which is showing here up by end of the year, early next year. And you see what even the short-term cycle is suggesting here. So all 4 short-term cycles, should I repeat that? All 4 short-term cycles align their faces and synchronize their top now. So that's, for me, even more important than maybe having the short pop here, which at least the data shows. But once this synchronization takes place, end of this year, early next year, all of those short-term cycles go into their downswing phase in combination in direction of the longer-term cycle. So that's the interesting window I would like to point out here in today's session, that from January and the whole first quarter of 2026, the daily cycles will synchronize into a possible topping formation, leading negative short-term cycle dynamics in the first quarter, which then goes hand in hand with the long-term business cycle dynamics of the materials, which already started end of 2024 and is still ongoing. So, right, do you get the point? So this episode here was to have a deep dive into the primary business sector, which is raw materials, using the S&P 500 materials sector index to measure that. The long-term cycle peaked end of 2024, which follows the price series now with during 2025, making a lower high, turning down now. Short-term cycles might suggest a pause or slight upward momentum until end of the year, while at that point in time, end of the year, early next year, the short-term cycles in the primary sector turn down in direction of the longer-term cycle. Now put the pieces together. We already analyzed the cycles in the secondary sector for production and construction and manufacturing, which has also come into a contracting phase. In addition, the primary sector also comes into a contraction area for the first quarter of next year, is already in contraction since end of 2024. So this does not paint a positive picture for business cycles dynamics in the first and secondary sector of the economy. I know, taking out the IT and services sector, but by design, because often those sectors are right now heavily underlooked. They make up a huge part of where the employment takes place. Today, people work not in the AI service sector. People don't work in the data centers. The employment is done in materials extraction, production and manufacturing. That's where Main Street works, earns money, and the economy takes place. Keep that in mind. And how the cycles look in those sectors is not the full picture, but it is also a part of the picture of the economy, the business cycle, and parts of the overall valuation we see then finally at Wall Street. That's it for today. So I would like to keep that series continuous repeating. So I would like to dedicate more time to different sectors of the economy. We can analyze the third and the fourth sector for sure. And then once we have done that, we can stack up the dominant cycles in each economic area as one economic business cycle, perspective. I think that's what's missing these days out there, just looking at Wall Street and the next big capex investment into AI. I mean, that's not the economy. Right? So if you would like to see more cycles on those economic areas, and natural gas is like those raw materials, Diana, I see your point here. So then please put a note in the comments here to that video, which helps me also to differentiate between what your interest is. At least I would like to spend more time in those sectors instead of just jumping on the overall index like the Nasdaq or the S&P, or just one stock, which are the extremes. So you can analyze the overall S&P or the Nasdaq, or you can then analyze Nvidia or a different company. But I think both extremes will not help us in today's world to get a picture of where the economy and the business is heading. And that's the reason I want to provide, or at least I want to help to provide more insights into that area. So I will close today's session with that deep dive of the materials sector for today. And then next week, same place, same time, Cycles TV. See you there. Thank you for taking the time today.